But are rates then done, for the most part, going up if you think things economically are going to weaken a bit from here?
My game plan remains the same, and that is that rates peaked for this cycle back in, October of 2022, I guess it was, or 2023. But 2023, they peaked. And I thought they would start falling as the inflation rate came down, and that happened. And I think we've seen the peak for this cycle in the longer-term bond yields and probably in the Fed funds rate. But I do believe that when the next recession comes, the Fed will act much more aggressively than they think they will. And I think that it will be problematic and that we will see significant reactions at the long end to inflationary fears and excessive Treasury supply. The one thing that's helping the bond market and what hurt the bond market last October was there was tremendous net supply. There was auction after auction, and the bond market couldn't digest it. That's down a lot right now. So the supply problem in the near term isn't that bad. But I think in the economic weakness that will come one day, it's like waiting for Godot, waiting for the economic weakness. But when it comes, I think we're going to have a scare on the government reaction being inflationary again.
You still sound skeptical that Powell is going to be able to pull this off, that they're going to get the soft landing that the market seems to be placing its high hopes on. Are you still looking for a recession?
Yes. It's a question of when. It's been a long time coming. Many of the recession indicators flagged a year or 2 years ago, but this was a crazy cycle with all of that government spending and then the retraction of the liquidity. But I felt like Powell himself was less confident today than I've heard him, I'd say, in about a year.
Interesting.
Because he seemed to have some mojo back in November, and I think he seemed to be pretty confident the earlier meetings this year. This was like an economist talking, not a private equity guy, which is more of his background. He's sort of like, on the one hand this, on the other hand that. I don't know what to look at. It's not one thing. I just felt like he said almost nothing today.
Well, doesn't he have to balance he has to balance the risks, right? He said that specifically about cutting too late or cutting too early.
But clearly in past meetings, there's been meetings where he's shown up more hawkish than people thought, more dovish than people thought. This one, he just seemed a little bit, wanted to keep all of his options open. So that's why I think Steve is honest up there, where he says, I'm not even sure that they're truly biased to cut. They're sort of biased to be biased to cut is, I think, where they are.
Let's run through a few investment ideas. Gold, we talked about it before.
Yeah, I've been bullish on gold all year.
It had coming off one of its worst day in some 3 years.
Well, that was the employment report. Yeah, but and it's back up to 2,300 plus handle. It's still quite strong. It's up 15-17% year to date. I just think it needs to take a break. I mean, it went up over 20% in about 4 months. So to take a break. But I believe gold is a worldwide economic thing, central bank thing. I think it has to do with worldwide indebtedness, and I think gold should be accumulated on weakness for sure. And even at the level today, I think it's worth dollar cost averaging. I own gold. I've been positive. That was my real asset pick at our DoubleLine Roundtable Prime first week of January. I had no idea it was going to go up so much, but that's the way markets work,